All right, now that we've done our variable costings or done our cost behavior of variable and fixed, now we can use that information and we're going to switch over to a whole nother concept, which is going to be our break-even analysis and targeted profit analysis. And we're going to have to look at a couple of these other issues, but that's the focal point. So I'm going to slide down here and say, all right, what happens if we turn around and use our same sales and our same net income, but what we have done is we've moved our variable costs into one section and our fixed into another. So this is an example of making a bicycle. If we sell the bicycle for $500 and $300 represents our direct materials, direct labor, variable overhead, and all of our variable selling and general and administrative, as long as it's all variable, then that bike costs us $300 to make. In other words, what it's going to do is it's going to contribute $200 first towards covering any fixed expenses, and once fixed expenses are covered, then it goes to net income. So what we're looking at is $200 represents our contribution margin, and when we put 200 over 500, we see that represents 40%. So our contribution margin is 40%. Let's move down. Okay. And now what happens if we just sell one bicycle? We're going to sell one bicycle. So our total sales will be 500, our variable costs will be 300, our contribution margin be 200. Our fixed expenses for this particular scenario is 80,000, so we would lose $79,800. Notice that when we sell two bicycles now, that contribution margin is slowly but surely getting rid of our net loss by $200 for every bicycle that we sell. So if we go a little bit further down here, now what happens when we sell 400 bicycles? Let me get rid of those other marks. Now when we sell 400 bicycles, you'll see that our sales is $200,000. Our variable cost will be 400 bicycles times the $300 is $120,000. When we subtract our fixed expenses, that's where we break even. And then you'll notice that when we sell 401 bicycles, that the profit increases here from $0 to $200. In other words, for every additional bicycle we sell, we get $200 in contribution margin that's going to our net income. So I guess right here I'd like to make use of this white space and show you the difference and see if you agree. That we have sales minus variable cost is contribution margin minus fixed is net income. And that would be our income statement. We could rewrite that instead of vertically. We could say sales minus variable costs is contribution margin, which is just a subtotal, minus fixed equals net income. And if you took the variable and the fixed and put it on the other side, you'd say sales equals variable plus fixed plus net income. So what we could do is turn around and say, okay, if $500 is our selling price and X is the point at which we break even, then we can say our variable costs are 300 times X. So $300 per bicycle. X, again, is the break even. Plus our fixed expenses, right, which was $80,000. And then because we want to break even, we're talking about zero profit. So in other words, 200x equals 80,000. X equals 400 bicycles. So at this point, because we've put all these costs into a variable and fixed component, we can see that we can break even at 400 bicycles. And this is a wonderful concept, because now marketing can tell you, what's the market going to bear? Are you going to be able to sell this many? They're going to go out and test market, and they do what marketing people do. We do what accountants, beady-eyed little accountants do with sharp pencils, is we run the numbers. And if we know that it's $500 per bicycle, then we see that the break-even point is that $200,000 that we saw in the previous slide. If I jiggle this a little bit to get rid of the marks, we can see that we can do the same thing, but use it in terms of percentages. So we can say 1.0x is our sales equals 60% was our variable cost plus 80,000 plus no net income. So 0.4x equals 80,000. So x equals 80,000. 80,000 divided by 0.4 equals $200,000. So if we use the decimal, then what we get is the break-even in dollars. The previous one, we used the contribution margin instead of the contribution margin ratio, and therefore we got the break-even in units. So it doesn't matter which way you do it. Another thing I'd like to point out is, in essence, this is the shortcut, that we had 80,000 divided by 0.4. That represents the fixed cost divided by the contribution margin ratio. And that will give you break even, that equals break even in dollars. If we took fixed costs and divided it by the contribution margin, then that gives us break even in units. So either way you go, you only just need to remember one formula, and now you'll be able to calculate the break-even point. The beauty of this is that you can go back in now with this target, and instead of it being break-even at 0, I'll jiggle this again to get rid of all my writing, and now we'll say, okay, we've got 500x plus, or equals, 300x plus 80,000. Now what if we wanted a targeted profit of $70,000? So we know that this is my equal sign I messed up on. We got 500x, that's 200x equals 150,000. Now x equals 750 bicycles. So we can turn around and say at a targeted profit of 70,000, then we would need to sell 750 bicycles to reach that profit. And if we wanted $70,000 after taxes, we divide this by 1 minus the tax rate. And if we were in a 30% tax bracket, then this factor here would become 100,000. Added to the original 80 and fixed would become 180,000. And now we would have 900 bicycles. So we can turn around and say, okay, we want 70,000 after taxes at a 30% tax bracket. Now we know that we have to sell 900 bicycles to make that work. And that's basically what the rest of these slides are going to show. So I'm going to zip down to them and show you a little bit of it. The 80,000 here represents the fixed costs. The variable costs are plotted on top of it. Then when you put a sales line across the top of it, the point at where the sales line meets the total of the variable and the fixed added together, that's your break even. So if you look in the next slide, it's very pretty that it shows you the profit and loss area. So you have a profit here, you have a loss there. The next one is just a rearrangement of it. So you can look at it from another perspective. A couple things I do want to point out is that if you know your sales are going to increase by 150,000, so if we're going to sell 500 bicycles and then we jump to 800 bicycles, which will give us a $150,000 increase in profit, we know the contribution margin's 40%. So if we know that 40 cents on every dollar covers the cost of making additional bicycles, and that's just the variable cost, that's a key point, is it's just the variable cost, then we've got 60,000. Now at $60,000, if the fixed costs don't increase, then 150,000 in sale will send $60,000 right to the bottom line. So that tells you that if you want to sell 300 bicycles more, if you want $150,000 more in sales, you can spend up to $60,000 in advertising or commissions or whatever, and you're still better off. So it's a very dynamic tool for businesses, for managers to have. The next couple slides then just do the same thing, but it uses the second method, the percentage method that I showed you. And then margin of safety is another concept that just says what's the dollar difference and the percent difference between what you made and then the break-even point. So if we look at two examples here, we have two companies that both make $500,000 and they both have a net income of $60,000. But one is very high in labor, so its variable cost is 70, fixed is low. Company Y is very high in depreciation, so this is a very automated company that doesn't have very much in variable costs, doesn't have much in labor. And you'll see that the margin of safety is going to be completely different. That if we take the fixed cost divided by the contribution margin, then we see that the break-even's 300. If we have 500 in sales compared to 300, the difference is we've got $200 that we could lose in sales before we hit the break-even point. The second company, Company Y, takes its fixed expenses divided by its contribution margin. You see that the break-even's 425, and with the 500,000 in sales, it's only got a margin of safety of $75,000. This is the whole fundamental concept behind manufacturing is once you hit that break-even point, then 80 cents on the dollar is going towards profit once you have reached that break-even point. But the problem is for every unit you don't sell that you previously sold, you're losing at 80 cents on the dollar. And this is why in the 70s, when interest rates went sky high, you had so many problems because you can't tell machines, don't come into work today. I mean, those costs are fixed. And so companies that were in highly manufactured were in just dangerous trouble, and so many of them lost. So many of them went bankrupt. I think that's the major part of CVP analysis. And so again, read your book, watch the videos, and give me feedback on what you think about them and whether I should continue. All right, thanks.